Options trading is a powerful tool in the financial markets. Basic options strategies like buying calls or puts are straightforward. However, advanced strategies can provide enhanced flexibility and improved risk management. Advanced option strategies, such as straddles, strangles, butterfly spreads, iron condors, and jade lizards, are essential for seasoned traders. These strategies can help navigate volatile markets and capitalize on specific market conditions. The goal of this essay is to demystify these advanced options strategies. We will break down each strategy, explain its mechanics, and illustrate real-world examples. Let's embark on this journey to master these complex tools and enhance your trading prowess. A straddle is an option strategy involving the purchase of both a call and a put option on the same underlying asset. These options have the same strike price and expiration date. This strategy profits from significant price movements, regardless of direction. To execute a straddle, you buy a call option and a put option at the same strike price. For example, if a stock is trading at $100, you would buy both a $100 call and a $100 put. The total cost is the sum of the premiums paid for both options. The straddle strategy is ideal in volatile markets. The risk in a straddle is limited to the total premiums paid. This makes the straddle a popular choice for traders anticipating major market events or earnings reports. Let's consider a real-world example involving BioTech Inc., a pharmaceutical company known for its volatile stock. Suppose BioTech Inc. is trading at $150, and there is an anticipated FDA decision on a new drug. A trader could set up a straddle by buying a $150 call option and a $150 put option, both expiring in 1 month. Suppose the call option costs $10 and the put option costs $8. The total investment in the straddle would be $18. If the FDA decision is positive, BioTech Inc.'s stock might surge to $180. Conversely, if the decision is negative and the stock plummets to $120, the put option would gain value. This underscores the importance of significant price movement for the straddle strategy to be effective. A strangle is similar to a straddle, but involves buying a call and a put option with different strike prices. Both options have the same expiration date. This strategy also profits from significant price movements, but with a potentially lower initial cost. To execute a strangle, you buy a call option with a higher strike price and a put option with a lower strike price. For example, if a stock is trading at $100, you might buy a $105 call and a $95 put. The total cost is the sum of the premiums paid for both options. The maximum loss in a strangle is limited to the premiums paid. This trade-off between cost and required movement is crucial for traders to consider. Consider implementing a strangle on the S&P 500 ETF, also known as SPY, during an earnings season, where significant market movements are expected. Suppose SPY is trading at $400. A trader could buy a $410 call option and a $390 put option, both expiring in 1 month. Assume the call option costs $5 and the put option costs $4. The total investment for the strangle is $9. If the market reacts strongly to earnings reports and the SPY moves to $430, the call option would be in the money, and the trader could realize a profit. Conversely, if SPY drops to $370, the put option would gain value. If SPY remains around $400, both options could expire worthless, resulting in a loss of the premium. The butterfly spread is a more advanced options strategy that involves 3 strike prices. It can be constructed using all calls, all puts, or a combination of both. The strategy profits from low volatility and is best used when the trader expects the underlying asset to remain relatively stable. To execute a butterfly spread with calls, you would buy 1 call option at a lower strike price, sell 2 call options at a middle strike price, and buy 1 call option at a higher strike price. For example, if a stock is trading at $100, you might buy a $95 call, sell 2 $100 calls, and buy a $105 call. The butterfly spread's risk is limited to the net premium paid. The maximum reward is achieved if the stock price remains at the middle strike price at expiration. It's ideal for traders who have a neutral outlook on the underlying asset and expect minimal price movement. Let's apply a butterfly spread to Amazon, known for its high stock price but relatively stable trading range. Suppose Amazon is trading at $3,200 and a trader expects it to remain around this level for the next month. The trader could set up a butterfly spread by buying a $3,150 call, selling two $3,200 calls, and buying a $3,250 call. Suppose the $3,150 call costs $70. The $3,200 calls are sold for $50 each, and the $3,250 call costs $30. The total investment would be $70 plus $30 minus 2 times $50, which equals $0. If Amazon remains around $3,200 at expiration, the $3,200 calls will expire worthless, and the trader will profit from the $3,150 call minus the cost of the $3,250 call. The maximum profit is realized if Amazon closes exactly at $3,200. If Amazon moves significantly away from $3,200, the trader's loss is limited to the initial cost of setting up the spread. The Iron Condor is an options strategy that combines a bull-put spread and a bear call spread. It profits from low volatility and is suitable for traders who expect the underlying asset to stay within a specific price range. To set up an Iron Condor, you sell a lower strike put, buy an even lower strike put, sell a higher strike call, and buy an even higher strike call. For example, if a stock is trading at $100, you might sell a $95 put, buy a $90 put, sell a $105 call, and buy a $110 call. The Iron Condor's risk is limited to the difference between the strike prices minus the net premium received. The maximum profit is achieved if the stock price remains between the short strikes at expiration. This strategy benefits from low volatility and a neutral market outlook. Proper implementation can provide steady income with controlled risk. Consider using an Iron Condor on Microsoft ticker symbol MSFT during a period of expected low volatility. Suppose Microsoft is trading at $250 and a trader expects it to remain within a $240 to $260 range over the next month. The trader could set up an Iron Condor by selling a $245 put, buying a $240 put, selling a $255 call, and buying a $260 call. Suppose the $245 put is sold for $3. The $240 put is bought for $2, the $255 call is sold for $3, and the $260 call is bought for $2. The net premium received would be $2, which is $6 received minus $4 paid. If Microsoft stays between $245 and $255 at expiration, all options will expire worthless, and the trader keeps the $2 premium. The maximum loss occurs if Microsoft moves below $240 or above $260, limited to the difference between the strikes minus the premium received. This example shows how the Iron Condor can be used to profit from low volatility in stable stocks like Microsoft. The Jade Lizard is a unique option strategy that combines a short put spread with a naked call. It profits from moderate price movements and is suitable for traders with a bullish to neutral outlook on the underlying asset. To execute a Jade Lizard, you sell a put, buy a lower strike put, and sell a call. For example, if a stock is trading at $100, you might sell a $95 put, buy a $90 put, and sell a $105 call. The total premium received is the sum of the premiums for the sold options minus the premium paid for the bought put. The Jade Lizard's risk is limited to the difference between the strike prices of the put spread minus the net premium received. The maximum profit is achieved if the stock stays above the sold put strike and below the sold call strike at expiration. Proper implementation can provide steady income with controlled risk. Let's apply a Jade Lizard to Tesla, ticker symbol TSLA, known for its high volatility and frequent price movements. Suppose Tesla is trading at $700 and a trader expects it to stay above $650 but below $750 over the next month. The trader could set up a Jade Lizard by selling a $680 put, buying a $650 put, and selling a $720 call. Suppose the $680 put is sold for $10, the $650 put is bought for $5, and the $720 call is sold for $15. The net premium received would be $20, which is $25 received minus $5 paid. If Tesla stays above $680 and below $720 at expiration, all options will expire worthless, and the trader keeps the $20 premium. If Tesla moves below $650, the trader's loss is limited to the difference between the put strikes minus the premium received. This example shows how the Jade Lizard can be used to profit from moderate price movements in volatile stocks like Tesla. Advanced option strategies offer traders a range of tools to navigate different market conditions. Straddles and strangles are ideal for volatile markets, allowing traders to profit from significant price movements. Butterfly spreads and iron condors are suited for low volatility, providing steady income with controlled risk. Jade lizards offer a unique combination of credit spreads and naked options, suitable for moderate price movements. Each strategy has its risks and benefits. Proper implementation requires careful selection of strike prices, an understanding of market conditions, and a clear outlook on the underlying asset. With the right knowledge and execution, advanced options strategies can be a valuable addition to a trader's toolkit. Embrace these tools and take your trading to the next level.